Okay, let's dive right in. So, we've all learned the basics of risk management, right? The stuff that's designed to help you survive in the market. But what happens after survival? Today, we're going to shift gears. We're moving from just playing defense to playing a really smart offense, going beyond just protecting your capital to truly optimizing its growth. So picture this. You've put in the work, you've back-tested, you've done your homework, and you have a strategy that actually has a statistical edge. But here's the million-dollar question. Are you really sizing your positions to squeeze every last drop of potential out of that edge, or are you leaving money on the table? And really, it all boils down to this huge distinction. Over on one side, you've got capital preservation. This is the world of the famous 2% rule. Its entire job is just to keep you in the game. But on the other side, you have optimal growth. And this is where we use advanced strategies not just to play the game, but to win it faster. All right, so let's get into it. Let's start by looking past that one fundamental rule. It's time to change our thinking from just defense, defense, defense to a smart, calculated offense. And look, let's be absolutely crystal clear about this. The 2% rule is your shield. It's non-negotiable for survival. It's what protects your account from a nasty losing streak or one really bad mistake. It's the reason you get to trade again tomorrow. But just surviving isn't the end goal, is it? Once you've got your defense locked down, the real question becomes, how do you hit the gas? How do you take that mathematical edge you've proven you have and turn it into the fastest possible growth for your account while still being smart about risk? And that leads us straight to our first advanced tool. This one comes right out of the world of math and information theory. It's called the Kelly Criterion. This is all about precision. So what is it? Put simply, the Kelly Criterion is a formula that's built to answer one single question. What exact percentage of my capital should I risk on this trade to get the absolute maximum long-term growth? It's a direct bridge between your edge and your bet size. Now, you're looking at the formula right here. Don't worry about the text not being in English. The math is universal, and it's actually pretty straightforward. It uses P, which is just your win rate, what percentage of the time you win, and it uses B, which is your reward to risk ratio, how big your average wins are compared to your average losses. It crunches those two numbers and spits out F star, the single best fraction of your capital to bet for maximum growth. But, and I can't stress this enough, this is a huge but. Using the full 100% Kelly formula in the real world is an incredibly bad idea. It's mathematically perfect on paper, but the market, well, the market isn't a perfect math problem. Why is it so dangerous? Because the formula is brutally unforgiving. If you're off by just a tiny bit in estimating your win rate, full Kelly can lead to some absolutely terrifying drawdowns. I mean, it can literally chop your account by more than half. It's that aggressive. And that's exactly why the pros don't use full Kelly. No way. They use something called Fractional Kelly. This is the secret sauce. It lets you tap into the power of the formula, but smooths out that insane volatility. In fact, studies show that over the long run, even using just half Kelly can produce growth rates way, way higher than a simple 2% rule, without all that catastrophic risk. And this right here, this is the sweet spot. Most pros and quant funds, they're only using a fraction of what Kelly tells them to, usually somewhere between a quarter and a half. This gives them that mathematical boost over a fixed risk strategy, but it keeps them safe from the extreme danger of the full formula. Think of it as your optimized starting point for every trade. So Fractional Kelly gives us that solid, optimized baseline. But what if we want to get dynamic? What do we do when things are going really, really well? That's where our next tool comes in. It's called Anti-Martingale, and it's designed to help you press your bets when you're on a hot streak. The easiest way to get it is to think about its evil twin, the Martingale strategy. That's where you double your bet after every loss. It's a one-way ticket to blowing up your account. Anti-Martingale flips that completely on its head. You increase your position size after a win. This is smart compounding in action. The logic is just beautiful in its simplicity. You win a trade? Great. You risk a little bit more in the next one. You win again? Okay, you risk a little more. Your position size grows as you win. But the second you take a loss, bam, you immediately cut your size back down, protecting your capital. Now, of course, there's a catch. The main risk is that one single loss can wipe out all the profits you just made. And that's why this pro tip is so crucial. You don't just double your bet. Instead, you increase your size by a much smaller, more controlled amount, something like 1.2 or 1.5 times. That way, when the winning streak inevitably ends, you still walk away with some of those profits in your pocket. All right, our third and final strategy is maybe the most aggressive one of all, and it's designed for one specific situation, a strong, obvious trend. It's called pyramiding, and it's all about pressing your advantage when the market is clearly moving your way. So here's the game plan. You put on your initial position once you've spotted a strong trend. As that trade moves into profit, you don't take your money and run. Instead, you add a second, smaller position. If the trend keeps roaring ahead, you might add a third, even smaller position. You're building a monster position, but, and this is the important part, you're adding smaller and smaller pieces to carefully manage your risk. Now, this is a high-reward strategy, but you better believe it's a high-risk one too. The single most important rule, and the source material basically screams this, is that you must be extremely compliant with your stop loss on every single piece of that pyramid. One sharp reversal without a disciplined stop, and the whole thing can come crashing down. Okay, so we have 3 really powerful tools, but they're not just separate tricks you use randomly. The real skill is understanding how they all fit together, how they form a complete system, your advanced trading arsenal. Think about it like driving a high-performance car. That 2% rule we started with, those are your brakes, plain and simple. Their only job is to keep you from crashing and burning. They're a pure safety feature. Then you have Fractional Kelly. This is like your car's sophisticated fuel injection system. It's constantly analyzing your engine's performance, your trading edge, and optimizing the fuel flow to make sure you get the absolute best performance over a long road trip. It's all about long-term efficiency and growth. And pyramiding? Well, that's your accelerator. You don't just slam your foot to the floor all the time, right? You wait. You wait until you see a long, clear, open stretch of highway, a powerful trend, and that's when you press down and unleash the power. But here's the bottom line. All of these amazing tools, the brakes, the fuel system, the accelerator, they all rely on one thing, accurate data about how your car performs, your personal trading edge. So the final, most important question isn't just which tool to use. It's how do you even get the data to use them? How do you find, measure, and constantly improve your own personal edge? Because that is the key that unlocks the power of everything we just talked about.